So this is the Institutional Investor Panel. I'm sure everyone's very interested to learn more about attracting institutional investors, and we have some great panelists for you to give their insight on. So gentlemen, why don't you introduce yourselves to the audience? I cannot speak enough of your accolades, so you might as well do it yourself. So start on the left, right here.
All right, my name is John Donovan. I'm a partner at Cohn-Resnick. I have been in public accounting for 34 years, coming up on 35. I've spent the first 33 and a half years with Big Four, or a couple of Big Fours, one being Arthur Andersen, that we all know what happened to those guys. I retired from KPMG about a year ago and then joined Cohn-Resnick 8 months ago.
My name is Ryan Kraft. I'm the founder of Saluda Grade. We are a boutique merchant bank style asset manager and advisor. Our core mission is delivering institutional capital access into the private lending markets. So it's probably one of the only panels in the world I'm qualified to be on. And we have three main businesses: an advisory group that focuses on delivering scalable and cheaper cost of capital into private lenders. And we have a growth equity business that finds our best-in-class advisory clients and looks to invest in both private lenders, fintech, and ancillary private lending technology. And we also have an income fund that looks to buy the loan originations from our portfolio of lenders and some of our advisory clients.
Excellent. I'm Glenn Tatham, the CFO and co-founder of Conventus. Conventus is a business purpose bridge lender based in San Francisco. We've been around for about 5 years. We've done a little over $2 billion of originations in that time period. Last year we were just under $1 billion. And we also have a companion fund in addition to the origination business. The fund has been around since day one. And it's certainly purchases loans from our origination company, as well as we do sell loans to third-party buyers. So that's the nature of kind of Conventus. And turn it over to John.
Great. Hey, I'm John Beecham. I'm the CEO of Toric Capital Partners. I'm a lender by background. I worked at Deutsche Bank for 12 and a half years in the commercial real estate group during large balance commercial real estate originations. Founded a company called B2R Finance, now called Finance America Commercial, which does single-family rental lending and bridge lending. And then in 2016, founded Toric Capital Partners. Toric is a KKR-backed fund that provides capital to lenders around the country. We believe we're the largest capital provider in this space by a significant margin. And we partner, we'll talk about this more, I'm sure, but we partner with lenders on a flow basis who originate loans to our guidelines that we then acquire and hold for our own balance sheet. We don't sell loans. All of our loans are held for our own account.
Great. Thank you so much. So what's really interesting about today's panel is we have an institutional investor, we have an advisor, we have an operator that actually works with institutions, and an advisor on the tax side that works with institutional investors. So you have multiple perspectives here. I'm an attorney, so you probably don't want to hear what I have to say, so I'm just going to be asking a bunch of questions. I'm going to try to avoid some legalese and just try to highlight these gentlemen's experience and really have an open dialogue and discussion about attracting institutional investors. So let's get started. So everyone wants to know eligibility, right? And I've just listed these topics here. These are just topics to kind of start the discussion. When we're talking about an institutional investor, the biggest question that I get is, how do I qualify? What do I have to look like? What do I have as a lender, right? As a loan originator, what do I have to look like to qualify? And everyone has a different perspective on it, so just, gentlemen, open forum. Feel free to just chime in and answer the question.
Well, I think from what I've seen, working with some of the largest PE firms in Southern California in the last 10 years, obviously yield, what you put up there, yield requirements, everybody needs a track record. And to the extent you don't have a track record, if you're a startup, it's going to be very difficult, from what I've seen in my past, for someone to attract an institutional investor. So track record is very important.
So our niche in the market and where we're able to create value for lenders is that, in a differentiated role from some of the aggregators out there like John, there'd be something more of trying to find bespoke strategic partnerships with institutional investors that are willing to buy a differentiated product that is different from your kind of more vanilla fix and flip or a vanilla more new construction in a differentiated product. So what we generally do look for is someone that needs our expertise to not only help them become institutionalized or institutional ready, but also has a definitive need with a different product that hasn't maybe been able to sell into the institutional market.
So they don't have to be a vanilla type private lender. They don't have to be just doing fix and flip only. They can be diversified a little bit.
Well, and I think that's the big thing about the industry and the asset class is that it's become more commoditized and it's become more generic, that there are big wide buy boxes for institutional investors out there. The aggregators and the securitization market exists. So when someone has a differentiated loan product that they need to see how they can work that in the institutional market, we're generally looking for that. And I think that above all, I think he has a great point, John, is that I think that the management team and the management team and the strength and the background of that has a big key role.
Okay. Glenn, you're the operator here. Any thoughts?
Yeah, I mean, I think it's a combination of things, as is always the case, right? It's not just one, but track record absolutely plays a piece of it. It's not just the management team, but it's also the entity too. So it's what has truly been the profile of what's been originated over time.
Right.
You couple management with that origination profile, then you get into loan performance.
Right.
Clearly, that's a key piece of the puzzle, is how well have the loans performed that you've originated. As folks dig in more deeply, they're looking into that operational profile that has created that, hopefully quality loan performance, and they'd like to see the rigor that's in place that creates a repeatable manufacturing plant, if you will. So we see kind of that combination when we have discussions with.
So I'm hearing a couple of things. Operational efficiency is also a very important issue then.
For sure, and I mean, efficiency is a piece of it. I'd say it depends on who you're talking to. It's really more about, is the operation set up to produce a quality product.
Right.
That may or may not be efficient.
Right.
Obviously, you'd like it to be efficient, particularly if you're dealing with an institutional investor that's looking at something maybe beyond just the asset. They're looking at the platform. They're going to be very intently interested in the efficiency of how well you can build the system to produce those good quality widgets. So I think it's, like I said, it's a combination of factors that are going to go into an assessment like that.
Now, as the investor, John, what do you think?
Well, there's a lot of different answers from different investors. I'll answer from Torque's perspective. We have about 50 lending partners around the United States. We probably say no to 9 for every one we end up working with. So there's definitely a lot of selection. For us, it's character is number one. Who are the people we're dealing with? What's their background? How much experience they have in this market? Have they operated through downturns in the past? Do they have a depth of staff, a significant number of employees who have real experience in the industry? What's the depth of the operational staff in particular is a really big deal. Track record is extremely important. What's the default and delinquency performance been of that particular originator? How has that performed over the period they've been operating? If they've been doing something previously to this, how would they do then? What's their background and how have they successfully built businesses over time? That's really important. Honestly, for us, volume is important too. We generally don't partner with lenders who do less than $3 million of sellable volume to Torque per month. And so a lot of people aren't up to that level or aren't able to get to that level in a short period of time. So that's not really a good fit for us. So we look for that as well. And I'd say most importantly, all these are important, but equally importantly, is the ability and willingness to create high quality mortgage loans on a consistent flow basis. Operations is really, really important. Can they produce the same loans every single time? Do they have lots of exceptions? Do they have lots of variations to their guidelines? Are they able to sort of produce consistent, well underwritten, homogeneous loans? It's very important for us. Because ultimately we're here to scale our business, and so we want partners who are able to scale with us.
So on the operational side, we have all 4 gentlemen talk about operational efficiency, some benefits on the integrity, all that good stuff. But John, question for you for a lot of lenders out there that are using a capital partner like yourself. Do you look for a certain size in their operation? Do they have to have like 20, 30 employees, have to have 50 employees? Or is it more, are they efficient and they have a very streamlined process?
Well, there's certainly a minimum size. If you have 2 or 3 people, that's probably not going to work.
Okay.
And you need to get up to a point where you have enough underwriters, closers, obviously the origination staff, generally people have marketing people.
Right.
And so you need to have an operation to be able to sort of generate the amount of volume that ultimately we want to acquire. So that's really important. But it's also important, as I mentioned before, the quality of the people. What's their background? How much they know about the business? There are people who have lots of experience in mortgage lending who are really good, and there are people who are sort of newer who aren't as good. So we spend a lot of time trying to understand who the people are and what they've done in the past.
And then that hits on number 5 here is the soft skills, right? I kind of want to expand on the soft skills because a lot of people overlook this. They figure, hey, I'm a certain size. Hey, I can originate a certain volume. I must, I must automatically qualify. So what are some soft skills that you feel that like it must be there? It's a must-have. All four gentlemen.
Credit. So there are two types of human beings, if I were to generalize. There are brokers and there's lenders, right? Brokers are the type of people who, and there are people who are really brokers who act as lenders, and there's people who are lenders who act as brokers. So it goes both ways. But brokers are people who ultimately treat loans as if it's their own money. They underwrite it to a high credit standard. They hold themselves up to a high standard. They're not playing for that one loan. They're playing for their reputation, the long-term success of their business, and the performance of their portfolio over time. And that's very different from people who are trying to see, what sticks on the wall, right? So that's a soft skill I think is hugely important in terms of what really is inside the character of the people. We figure out pretty quickly if people are brokers or lenders. It becomes very, very apparent very, very quickly. And we look to find people who are lenders.
Yeah, I would echo.
One of the things, I was just going to go back to operations a little bit, at least from the advisor side, and what I've seen is, are your financial statements in accordance with U.S. GAAP? Do you use a fund administrator? How are fees calculated? What does your waterfall look like? Those are all the sort of the key things that, from my perspective, that I've seen.
Glenn?
Sure. I was just going to echo a little bit what John said. When we set up the business at the outset, I mentioned we had an operating company and we also had our fund.
Yeah.
And really that fund was friends and family driven out of the gate. So every credit decision we made as we were kicking off the business was really going to impact all of our folks that had invested in that. So it created a fiduciary mindset. Mm-hmm. And I think that's a differentiator in terms of how we've done it. And I think it does lend itself to what John described, that there's folks out there that are distributors and there's folks that are truly thinking about the longer term and the balance sheet implications of kind of the credit decisions they're making and the widgets that they're producing. It certainly permeated the way that our company was founded, built. Every single employee has that fiduciary mindset. That's still a core value within the company. So I agree with you. There are folks out there that are throwing spaghetti against the wall, as you described, and then there are others that are thinking truly of the long haul. We certainly like to think of ourselves in that latter camp.
Ryan, any thoughts?
Yeah, everybody talks about underwriting. It's clearly credit. It's clearly important. Just to throw out something different, customer service.
Okay.
And I think that this actually doesn't get discussed enough. One of the reasons why we're very interested in private lenders and originators in the space, when you look at owner-occupied and traditional mortgage originators, generally have repeat borrower rates sub 1%, sub 2%. The average in our space, from what we've canvassing 200, 300 lenders, is going to be generally between 60 and 70%, which is a huge recurring borrower base and recurring customer base. So we think that that's extremely interesting when we're looking at the equity and evaluating that company. So, one of our lead investments is Chicago's #1 lender, Renovo Financial. Yeah. And one of the cool things they do is actually track TPS scores. So TPS scores, if outside of Office Space and TPS reports, you would know about so Nike and Apple and the biggest brands in the world. If you look at who has the highest TPS scores, it's Nike, Apple, and Tesla. Right. And so this one lender, Renovo Financial, actually embedded this 8 years ago, and they actually have a score that's in that range in the low 90s. So one of the things
that's an indicator for repeat borrowers.
Right. That's an amazing indicator for repeat borrowers, because if you can embed yourself into the business practice of your borrowers, you're not really fighting about rate anymore. You're not really fighting about other things. So it creates a much better ecosystem to expand your business. And expand
Steve Pollock talked about that earlier today on his panel. Repeat borrowers, they'll pay a little bit more for the customer service.
I mean, that's the reason why the business exists, right? If you could wait time, you would go to a bank.
Exactly.
Right? So the speed, they're willing to pay more for the speed and ease of the origination process.
So John, let me ask you this. So among your partners that you're working with, how many of them have that large volume of repeat borrowers?
The vast majority of them do. You're absolutely right. I mean, this is
well, you know better than anybody. What's the stat?
Yeah, we're looking for people who are professional, renovators. Right. If you're a professional renovator, if you're a professional investor, you're going to do deal after deal after deal. The average number of deals that someone that we ultimately fund is probably between 7 and 10 individual deals. And if that person is not going back to that existing lender, there's generally a problem with that. I mean, it's a pain to get a new lender relationship. You have to understand how they work. You have to develop that relationship. You have to have that trust level they're actually going to close. And so once you have that relationship, it's absolutely a big deal.
When you're underwriting a partner to invest with, Are you evaluating that aspect of the business in making your decision as to onboard them?
I would say it's a secondary issue for us because ultimately we're primarily concerned with the credit quality of the loans.
Right.
But from the business perspective of their operating the business, it's huge.
Right.
I mean, your cost to acquire a new customer could range from $2,000 to $10,000.
Sure.
You get the marketing time, the staff time, and all that. And if you can get a higher percentage of your customers to be repeat customers, your business can run much more efficiently. Your marketing budget's going to be small. I mean, Anchor Loans, a good company. They're in California. I don't think they do any marketing or very minimal amounts of marketing. And they are one of the biggest lenders in the country because they have a great reputation. They do loan after loan, and so the market knows them really well as an example of a local lender. But it's really helpful for your business, less directly relevant to us, the loan buyer, but ultimately we want our partners to do well, so it's helpful to them.
In reality, it's a factor, but it's not something that it's not a critical factor then. Okay.
No, really the credit.
Credit, right.
Credit. You have a box.
Right.
Okay? And so you have to have an LTV that looks like this. Then you look at the appraisal and the comps don't seem right. Or there seems to be a math error in the appraisal.
Okay.
Or you talk to the bar and they mention that his mom lives in the roof or in the attic or something like that. So, you
happens, guys.
Hopefully not in the roof. But these things are things that don't come up in the loan application, but people hear this and they see this, and good lenders will decide, hey, that doesn't make sense. I really don't want to make this loan, or I'm not comfortable about it. So there's all these factors that go beyond the documents that go into the subjectivity, and ultimately what drives credit performance is that feel, on a loan.
Well, see, I heard one thing earlier that I'm actually very interested in, because a lot of my clients I have very kind of divergent opinions on this. Well, some guys say, I'm just going to do one thing and do it very, very well, right? One loan product, this is all I'm going to do. Other folks tend to be a little bit more open-minded, have a little bit of diversification. I'm hearing from you that you prefer I do one thing, this is all we're going to fund, this is all we're going to do. Right?
Yes.
Discipline, right?
I think discipline's really important because then you can ultimately scale your business and do well.
Right.
It's very hard to do 5 things at once. I'll give you an example. We do residential bridge, for 1 to 4 family. We also do a lot of multifamily acquisitions. So about 25-30% of our book is multis. And I've seen lots of people in this industry start off as residential bridge lenders and try to move into multifamilies. And what happens is that there's 2 models, and one's really successful and one's not. Model A is you have your residential originators and loan officers and underwriters ultimately sort of doing the same work and trying to underwrite those deals. And honestly, I haven't seen that ever work really well. Because underwriting a multifamily is fundamentally different than underwriting a single-family property, and those people just generally aren't good at it. And then there's other people who go and have specialists. You have a multifamily person. This is all you do is you underwrite and sometimes originate multifamily loans. And those companies tend to be really successful. So that's one example. We have a 30-year DSCR product that's really honestly doing extremely well. We've started this late last year, and now we expect within a year it's going to be our dominant product actually at Torak. But it's a product for investors who want to hold their properties for a long period of time, post-rehab, with a tenant in place based upon the DSCR of that particular loan. And similarly, the people who are starting to originate that are doing really well will have generally a separate person within the organization that focuses on that product, because it's hard to remember all the rules of that product and a multifamily product and a single-family bridge loan product at the same time and do those all well. So really, as an originator, I think you need to start with a product, do really well at that, and then add other silos over time that allow you to have centers of excellence across multiple different products as opposed to having the same person do everything. Now, that's hard as an originator because you have your best loan officer. And that loan officer is going to see all these deals. And so the challenge as an originator, which I know, I used to run one, is that you have to figure out a way to compensate the loan officer and ultimately get those leads over to people who can execute those really well. And that's a management challenge, so to make that happen. But from a success standpoint, that's really the key in our view to really
So
scale.
Ryan, you talked about earlier about some of the clients that you're working with that have more of a kind of a unique product, more of a kind of not so cookie cutter product. Is this they still kind of focus on one type of loan product, or is it they're a little more diversified and the investors that are okay with it? What is that situation like?
I think John has a great point. I think you need to focus on what your core differentiator value add product is. But I think as long as you're adding the correct resources that doesn't dilute your superpower, if you will, or your institutional ability to sell yourself as better than the rest, or at least at the same time ability to to drive good loan volume, I think that that's okay, to want to scale. And I actually think that that's what all private lenders should be doing, is because I believe that they have a borrower base, i.e. the real estate developer, real estate investor, that naturally sees a lot of this deal flow and doesn't think about doing the other type of loan or the other type of access, or the other type of structure until they have the ability to get that financing.
Well, Glenn, so in San Francisco, you guys are based in San Francisco, you guys get all kinds of deals, and there's all kinds of properties in San Francisco. And as a lot of my clients in your position, it's hard to say no to these deals. So are you guys in the same boat, or are you guys a little more diversified? How does that look like?
Our strategy has really been to follow the customer. And
Okay.
so we started out very simply as a kind of purchase money, fix and flip lender.
Right.
So we would loan on the purchase, let the borrower take care of largely a cosmetic rehab. As the customer started to push more for us to get into, we needed a loan on the rehab as well. We started to add additional personnel to kind of accommodate that.
And did you follow the same kind of path that John's mentioning?
Exactly. I
Adding
mean, that was it.
the
You
people?
had to bring in specialists that started to know more about construction,
Right.
more about kind of rehab activity. That then got into more heavier construction projects. So we brought in more people. So there is a team. We have a construction team that is part of the underwriting group that evaluates that. So
And your partners are okay with that? Your institutional partners are okay with that?
obviously, it's the proof's in the pudding.
Right.
To John's point, we can say this, but he's going to look at the tape and he's going to certainly dig into the loans. And so that's a piece of it. We have to kind of raise our standard to the level of our partners that we're working with. It continued on. We got into multifamily, and then even we're about to launch the long-term rental product that John mentioned as well. So in each of those cases, it's all about kind of ensuring that, A, you're meeting the customer needs, but you can't race there. You have to get the right people in place to properly build out the system to do that. Not easy, but that's the path that we've taken.
So message, guys, if you're a fix-it lender, don't all of a sudden start building hotels by yourself, right? Random. I've seen it happen, and I've seen a lot of clients all of a sudden take the, dive off the deep end because they decided to take on a project that you really could not handle. And their investors, not just their institutional partners, but their retail investors, were just scratching their heads, and then you have lawsuits coming, so no one wants that. So, okay, so let's get into the next section. The underwriting experience. I call this the proctology exam, all right? Because I'm an attorney, and so I have clients who get underwritten by institutional LPs, also buyers and other providers, and the DD experience can be pretty thorough. And so I want to find out more about your experience in this underwriting process. What does yours look like, John? Right? How have you guys been through it? How have you been involved, John? And what are you seeing as the issues?
Sure. Well, for us, we do a lot of work and our partners. So we're in the get to know people really well, have really long-term relationships, and spend a lot of time with them sort of model, as opposed to other versions of this. But so we go and spend a full day on site with all of our lenders before we even
In their office?
In their office before we even buy a single loan. So it's a whole process. We hire a third-party consultant. We go through their underwriting practices. How do you underwrite? How do you select appraisers? How do you review appraisers? How do you get loan documents? Who are your lawyers? Literally everything from customer acquisition down to actually funding and closing the loan. And we find stuff all the time in this, we let the borrower pick the appraiser. Well, that's, not a good system, right? Obviously, and there's one example that comes up. And so you sort of find, hey, these are things we need to do. And so we ultimately come back with a report. Here are the things we've sort of found, that we have the best practices that you're not doing, and ask our partner to sort of do that. The other thing that's sort of, I think, different about us a little bit is that most of the capital, and people should understand this, in the market that's institutional capital like Torak, is some version of show me what you got and I'll tell you if I like it, right? Which means that you as an originator are making the loan, you're then showing it to the capital provider is saying yes or no, and then you're at risk ultimately for them saying no on that loan. And so we're very different in that we have clear set of guidelines and credit criteria. We give our partners a loan sizer so they can literally type in the characteristics of a loan and figure out that's going to meet the Torak box. And so that really empowers our partners to know with confidence when they're actually committing to their customer that that's going to be a loan that Torak's going to want to buy. That also means we got to spend a lot of time with that originator educating them about our loan box. Here's the first thing we do when we have a new origination partner. Before I even talk to you about economics or anything else, here's our guidelines. Let's read the guidelines. Let's talk about that and see if there's any issues with our guidelines, get something that we're going to buy off of. And the originators that sort of really read those guidelines and come back with comments and questions, and what do you mean by this? And my experience of in this doesn't work or whatever. Those are the ones who are really good, thoughtful originators, and we like to see that. So we spend a lot of time educating them about the loan process, because we don't want to get to the end and say no. So it's about teaching them ultimately what makes a good loan and what type of loans we want to acquire.
I think it's worthy, totally makes sense from the perspective, maybe can you, and I'll pretend I'm Kevin for 2 seconds, can you talk a little bit about the difference between that and then the experience you guys have had when you've been out on the road for the securitizations you've done? I mean, it's them then evaluating you, right, which is a little bit of a different twist than you looking at the borrower or the lender, if you will.
That's a good question.
That's a good question, actually.
Because you're on both ends of it, right?
Yeah, we'll be on a road show many times, and I'm sure I'll be many this year. I would say it's always a little surprising, the issues that the bond investors focus on. I mean, we do this for a living, and we talk to everyone all the time. I talk to lenders 20 times a day, so we see all the problems in the industry. And I found that bond investors tend to be more thematic and more high level. I mean, you have a bond meeting when you're going on a road show is maybe 45 minutes to an hour. And you're going through a book, you're presenting your story, and there tend to be the same 20 questions, or if that get asked in every single one of these. And so it's honestly much less of a depth of sort of review of us than when we're reviewing an originator. I think ultimately the bond investors are saying, hey, this is the reputation, the background, the track record of the individuals and the sponsorship of the entity that's coming into market. Here's the performance of our prior securitizations. Here's the default and loss performance of our deals. And so that becomes really, really important with the bond investors, because ultimately if we have loans that don't perform well, that becomes very obvious, and that's going to be reflected in our pricing, our ability to execute bond deals. So they focus a lot more, I think, on the output and the ultimate statistics, what's your LTV, how you get to your LTV, those things, as opposed to the process. And so we are, as a reviewer of originators, really focused on the process, how they get there, because we know if you have a good process, ultimately the loan at the end will be a good loan that conforms. That's a good question.
Interesting. Yeah.
It's fundamentally different.
The bond process, you have a lot of tools that are installed by the attorneys to give comfort that you're not going to get when you're underwriting an originator. They're not going to get you all those comfort letters and negative consent letters and all those issues that.
Yeah, I mean, we go on a bond deal. We're going and hiring a third-party due diligence firm to review every loan.
Right.
Those loans grades go in the offering document.
Right.
We're hiring Ernst & Young to go do a tape the file on every single major field to make sure that those all what we're disclosing in the offering document is consistent with the loan documents. And we're doing our own due diligence process, and we have multiple underwriters and lawyers who do their due diligence as well. So you have that process, which I think gives bond investors a lot of comfort that the disclosure is accurate. I mean, I'm as CEO of a company, I'm liable if we materially misstate something. So that I assure you put in place a lot of procedures to check and double check and triple check all those numbers to make sure they're accurate.
So I want to go on to other issues on the underwriting experience. So let's talk about the behind the scenes. John, financial issues, financial reporting issues, tax issues. When you get involved in an institutional underwriting process, what are you doing? What are you seeing?
Well, I think it goes to, in terms of what you were saying, in terms of financial reporting, what kind of internal controls do you have? Have you had any significant deficiency letters, any material weakness letters? Those are all extremely important. Who's your administrator? How well do you work with your administrator? How transparent are your financial statements? And then, you need to have good quarterly reporting, I think, even though that's, unaudited information. How well is that? How transparent is that? So I think those are all key points in terms of financial reporting.
Any thoughts on the underwriting experience, if you will? I'm sure you
I
helped
think
out a lot of it.
I think a lot of lenders have been through this. It's getting to be more of a generic or commoditized process, and they probably understand it.
On the buy side, on the loan buy side, and the flow side, yes. Right?
Yeah, but if I had to add anything, I think this whole industry has effectively grown up in a bull market, right? If you look at 2011, 2012, it's been a bull market in housing since then. So what I want to ask, what are your loss mitigation strategies? How do you handle things when things go bad? I want to ask, how often do you extend loans? Why do you extend loans? I think everybody knows in this room sometimes lenders extend loans to generate fees, and that might be a sales tactic. It might be a behavioral tactic to help borrowers, remind them that they need to hurry up. Do they refinance other lenders' loans? I generally don't like to see that. If there's a reason why. And then also, if something does default, what are their cum loss rates? I think cum loss rates in the industry of guys that I've seen about 20, 30 bips I'd love to hear John's view on that. But then, do they have resources in-house to maybe take over a project in a certain amount of time?
Right.
I actually believe the greatest loss mitigation strategy as a lender is to bring in your next best borrower to come in, finish it, give him incentive to finish fast. I think that, one of the things I love to hear around loss mitigation is urgency, time. Time is money, and especially where you really want to focus on dangers and risk is in a falling down market. And I think that getting through that process of finishing the project and selling the property is very valuable. So I think that a lot of lenders in the space probably haven't had a huge amount of experience in tough scenarios. So I think that hearing how they would go through it and how they would visualize dealing with it is important.
That's a really good point. Lately, the underwriting experience has become very kind of cookie cutter. You can expect what they're going to ask, what they're going to look for. I mean, I did not know that you guys spend that much time personally with the quality time. That's something you can't hide anything there, because you're going to see the originator, the lender, warts and all, because you're in their office. Now, Glenn, I got to ask you this. So you've been underwritten, right? You have institutional partners. Give us some experience. Was it really a proctology exam? What can we expect?
Yeah, I mean, I think it really depends on the bucket that we're talking about.
Right.
All of the items that are listed on the screen absolutely play a role for sure. If you're dealing with an institutional partner that's really more interested in the asset, I think it tends to be a little bit more leaning towards where John was heading, around kind of the nuts and bolts of the specific kind of loan tape, if you will.
Yeah.
If you're dealing with an institutional kind of investor that's looking more at the platform, then you have a whole different host of
right.
issues that come up.
Equity versus debt.
That gets back to kind of people, process, technology. What is, in each of those three kind of key fundamental buckets, what are we dealing with? And they're really digging in on all of those fronts to see what's really driving, if you will. That
And when you say everything, give us an idea. What is everything?
Well, let's take process and take technology of the three that I just mentioned. Clearly, as you look from soup to nuts, from origination through to servicing, they're going to want to see policies and procedures all along the way. What is it in your origination effort? What are the policies there? How does that feed into your technology system at the outset? That goes into operations. Once again, very intensive in terms of process, policies. How do loans kind of migrate through the entire kind of chain, if you will? And are your systems robust enough to kind of track and monitor that and make sure that, as loans are being produced, if there's exceptions to guidelines, those are being flagged, and how do you deal with exception kind of activity? So it's that gives you a flavor for the kinds of diligence, if you will, underwriting that's going to go on with a large institutional player that's interested in more than just potentially just the asset itself when they're looking at the platform.
Yeah, they're really looking at the entire process from start to finish. Sure. Now, one thing I do want to note, so there is a difference when you're talking about, I call it debt versus equity, if you will, right? LP versus asset acquisition. And one of the things that on the equity side that we at the law firm really get involved with constantly is really random slaps on the wrist by your local regulator even. Like, we are asked constantly about, what was this consent letter with the Department of Business Oversight in California in 1998? To that granular level, to they ask questions about your insurance policies, your registration as an investment advisor if you are one. So it is a very broad gamut, and it's a good segue, kind of talking into equity versus debt, right? So, Two Rock Capital is definitely in the debt space. You guys are in the acquisition space. You guys are funding. But is there anything on the equity side for you guys? Do you guys do anything on the equity side for our clients? Is there any interest in that space?
No.
And I want to talk to the panel about this because I have noticed a significant drop-off in the institutional sector, whether it be even pension plans and the endowments, in getting away from LP investments, right? You're not seeing as many fund of funds as we did when I first started out. So
it's hard. You mean LP investments in the originator themselves?
Yeah, well, in a fund maybe, right? In a fund, or even in the operating company.
The problem is, from our standpoint, if we invest in some fund that some originator has, they don't get any leverage on that. They certainly don't get leverage the way we get it. We can't securitize that. There's no diversity, originator diversity, geographic diversity.
Right.
So it's much more efficient for us to take loans from 50 lenders around the United States in 47 different states, blend those together, and the execution and the efficiency of the financing on that is going to be so much better than what one originator could possibly get to by themselves. So it just doesn't make sense to invest in.
Are you asking
Equity
equity in the originator or a fund investment
It could
into
be
a
one
pool,
or the other, right? I've
fund?
seen, I used to see a lot of equity investments, both in what I would call the GP, the actual operating company.
Well, does
the
Torek
management
invest
company. In the
in
management
equity
company,
and
yeah.
origination platforms?
No, we generally don't invest in the equity and origination platforms.
Yeah, I haven't seen any much in terms of investment.
In the private lending space.
In a GP.
Right. And now in the fund space, right, so the LP investments, lender has a fund, right? They have investors in there, whether it be retail, whether it be family office. I'm also seeing a drop-off on, I guess you'd call institutional investment in these LP funds. And I would like your guys' thoughts on that. I mean, is it true? Am I right? Am I wrong? And why?
I mean, I've worked with a major lender in a real estate fund in LA. They've gone from $1 billion to $8 billion in the last couple of years. So they've been able to raise. They're probably on their 5th fund now, and so there is appetite.
There is appetite, but
There
that's
is
real
appetite.
estate. That's real estate.
That's commercial real estate.
They're building properties, they're acquiring properties.
They're lending to
They're lending.
developers who are developing office buildings.
Okay, so it's out there. You're seeing that
Yes.
on the tax advisor side, Ryan?
I think the distinction between this is there are professional asset managers like
Yeah.
KKR,
Yeah.
like a very large mutual fund,
Yeah.
or that are paid professional asset managers that raise funds from either broad retail base or other LP investors.
Right.
Right. So as that is naturally a lower cost of capital, and that's what we've been grinding down towards. I think some of the institutional money you might be referencing that would be investing into a lender's fund, a pooled fund, might be smaller institutional,
Yes.
like a family office, et cetera, et cetera.
Yeah.
So those are going to naturally be those are probably more of the 3-4 years ago institutional money in the
Right.
in the industry.
So
and
you
now,
you agree that there's been it's not out there anymore.
and that's what John's saying is that big asset managers have come in, and there's a lower cost of capital. There's technology like securitization that can deliver a lower cost of capital, and that's what's essentially crowding out what used to be institutional capital in the space.
Yeah, if you look at this space, generally, this space is anachronistic a little bit, in that every other part of the mortgage space is totally standardized. You make a consumer loan, there's a 1,500-page Fannie Mae seller guide that defines everything that's in that loan, and all those loans are basically sold to Fannie or Freddie Mac, and they're all packaged up and sold and standardized. If you look at commercial real estate, there's CMBS conduits that basically do the same thing, and they originate loans and they securitize them. And this market's been sort of weird, honestly, in that it's the only place in the mortgage world where you could actually have a fund, and the yields were high enough in the space where it sort of made sense for retail investors to invest in those funds. But that's nowhere else, right? This is a unique space. This is it. Anywhere outside of this world, this room, that doesn't happen. And I think historically that's been because we had really no institutionalization of the space. You had lots of different lenders having their own funds, raising money from friends and family or high net worth people, selling whole loans on the internet or whatever. And these models are inefficient because ultimately none of these ultimate investors can get financing, can get good capital. And so for the same reason that I think all the other mortgage markets have kind of gone towards an institutionalized approach, we're seeing this market go towards that. I'll tell you, at Torak, the loans we bought in 2016, have 200 basis points higher coupons than loans we're buying now. There's been a massive spread compression of yields. It's going to continue in this market. Spreads are going, rates are going down. They're going to continue to go down because it's getting to be more institutionalized. It's just this is becoming a market, I think, that's like every other market in the mortgage world.
It's becoming a mature asset class.
Absolutely.
I think we're still in the middle innings, but
Right.
via securitization.
And I've had so many conversations with clients who always comment how fractured this market is. It's now starting to mature. Right? It came out. We came out of this market, out of the recession with a glut of inventory, with no access to capital except for retail investors. That's very true. So I can't echo that sentiment enough. And I'm a fund attorney, right? I create funds for a living. So it is very true. And I'm not seeing as much activity on new fund formation or investors even interested in getting in. But I am very optimistic to see the industry grow up, right? And I am very interested to see what type of, I guess you'd call the technology on the securitization side, how creative we can get, because the asset class is very unique.
Well, what's I think interesting about this industry, and one more thing I'll say, is that this industry has done a poor job of servicing the customer. Let's look ourselves in the mirror and agree that, okay? Like if you look at a normal home loan for someone buying their first home, 80% of those are financed. Like almost everyone buying their first home gets financing. You know what percentage of investors get financing right now? About 25, 30%. So that means 70% of the flips in this country right now, the investors are choosing to opt out of the products that we're offering here. That's because, in my view, rates are crazy high, there's no standardization, every lender does things differently, and therefore the products are not really good, haven't been historically great products. I mean, you have like the Dutch interest system where you have to pay interest on money you don't even get. Who wants to do that? That's not a fair thing, right? So that's going away. And so this market is standardizing, rates are coming down, products are becoming more customer friendly, and the net result of that is that customers are opting in. So the percentage of deals that are getting financed is increasing every single year, because what we're doing as an industry is becoming a more attractive proposition to the ultimate customer. And so therefore the scope of our market, the total size of this industry is increasing. And honestly has a chance to double and double again, maybe not double again, but certainly increase by 1.5 times, just solely because we're creating better products that customers want to take. So the big competitor to everyone in this room is not the other people sitting around you. The big competitor to everyone in this room is cash, because that's what most investors are choosing.
All right. So one thing, we're kind of running short of time, but I want to ask this one question from the sponsor perspective. When I say sponsors, the people taking the investment, okay? Not all institutional investors are created equal. All right, so especially for the operator in the room, right, on the panel, Glenn, what are you looking for when you are being courted by various investors? What are you looking for?
It's good looks and charm.
Exactly.
The fix and flip model, right, on Bloomberg.
Cash, yes. For us, it's really about fit. It's about finding partners that have the same mindset that we do, the same view, the same kind of rigor around whether it be credit or diligence, and you know, there's that fit, that cultural kind of connection where we feel like we can work together to create the right kind of plumbing to where it's a win-win. Mm-hmm. So it sounds cliche, but fit is really the key piece for us.
Well, you're basically married to the person, so it might as well be a good fit.
For sure.
Right? Yeah,
for sure.
Ryan, any thoughts?
Yeah, I mean, I think the biggest thing here would be flexibility, right? So, you know, the very commoditized, standardized conduits that do exist out there with aggregators or other big buyers, there's always going to be the fringe loans around it. There's always going to be a story loan. There's always going to be a need for, hey, this one should fit, but it doesn't. Right. And I think being able to call up the institutional investor and explain that and say, okay, yes, we should. So sometimes I think that's hard in securitization models because you have to have things bracketed, right, for not only you know, lead investors and eventually I think probably next 6 months a rating agency. But I think the biggest thing that I would look for would be flexibility.
Okay. John?
When I talk to originators, they want speed, transparency, and reliability. They want to know when they make a loan that loan's going to get purchased. It's going to be purchased quickly, reliably, in a short period of time, and it's going to happen every single time.
Because they're a customer too, right?
That's because they need to deliver to their customer. They spend a lot of time getting that customer, getting to the point where they're actually ready to sign the loan. And the worst thing that happens to that originator is their capital gets pulled and they can't close the loan. So it's predictability, speed, and reliability is kind of what I hear and like what I think is the dominant thing. And that's hard because if you don't have a system where you're actually saying, okay, this is what I want to do, just show me what you got and I'll tell you if I like it kind of model, then that's the opposite of that, right? And that's how most of Wall Street historically has sort of operated. So it's that, you know, kind of standardization and institutionalization, which creates the ability for the originator to deliver to their customer, which is what they ultimately care about.
All right, guys. Well, we're out of time. Alicia's giving me the death glare, so we got to end. She's sweet. I promise. I'm joking. But I want everyone to give a big round of applause for our panelists. Thank you guys so much.